right. I love that inspirational music. How's everyone doing? Good? All right. Let's get some energy. Let's get. These are the VCs.
Make them stand up and do it.
Any entrepreneurs in the audience, if we see you slouching around your phones, you're not getting any money raised, right? So these are the folks who are going to give you money. Okay, so we're going to kick it off. Yalda, you manage, or you're the co-founder of a $1.5 billion VC and Secondaries fund. Okay, one of the trends we've seen over the last, let's say, couple of decades, maybe it's been a little bit taken aback in the last few years, has been a shift from public market investing in tech to private market investing. So is that first of all, why has that trend occurred, and how much of a derailment have we seen in the tech correction of the last 18 months?
Yeah, that's a great question. I'd say the main factor that's driving the trend away from public markets and more towards private markets is value creation. If you think one decade ago, you had only 30 known unicorns in the American market for a total market cap of the VC industry of about $50 billion. Now you have over 200 known unicorns. You have a market cap of that market that's exceeding $290 billion. We're expecting it to go to $700 billion over the next 5 years, which is a 21% CAGR. 10 years ago, or let's say 2 decades ago, you'd have a company like Amazon with 250 employees and only $15 million in revenues, IPO at a $300 million valuation. Amazon is now worth $1.3 trillion. So the value creation would occur in public markets, where you had the growth from 50 million to $1.3 trillion. Nowadays, companies are staying private much, much longer. You have companies with market caps of over $100 billion. Think of SpaceX, think of Stripe, think of ByteDance. They are still public, they are still private. They will not go public until they have hundreds of millions of dollars in revenues. They're worth more than 100 billion. So that exponential wealth creation from 0 to 100 billion is happening in the private markets and not in the public markets. I'll add 2 more things that is also driving the demand. We're seeing a real blurring when it comes to asset allocators between those growth high-tech companies that exist in private markets and the ones in public markets. If you think of Brackett's portfolio, we have companies like Epic, again, Stripe, Anduril, etc., that are much more dominant and much bigger than their public market counterparts. So by virtue of asset allocators deciding to allocate to that sector, regardless of whether it's public or private, you're seeing a large move into private markets. I'll say the last thing that's driving the shift away from public markets and more into private markets is the arbitrage opportunity that exists within private markets. Think of Goldman Sachs versus Stripe. You have more than 1 billion shares of Goldman that trades hand every day. You have 200 million shares of Stripe that trade every year. Public markets are very efficiently priced. Public markets are very efficiently priced. Private markets give you this opportunity to make your own market. And that's also driving the demand for private markets compared to public markets.
We'll come back and talk about the illiquidity discount or premium as you see it. Jörg, what are you seeing in Europe? Why do you agree? What's driving this shift from public to private? Is it this illiquidity premium? Is it a belief that you can get higher returns because of the opacity of the private market? What's driving it?
I think there are 3 dominant effects which drive the shift. One is the increased interest rate scenario, which certainly puts pressure on traditional buyout and leveraged equity deals. Second is the inflation, which puts pressure on all companies which have a high P&L with goods they need to purchase in order to produce their goods which they sell. And the third factor is certainly the global challenges we are seeing with the increased uncertainty in the world, which puts a lot of pressure on traditional production companies which do not have the ability to source the materials they need for the production, and this at the same time gives a lot of tailwind to the venture capital industry, because on the venture capital side, those companies are innovative, they create new materials, they create more energy efficient production ways which are needed by those traditional companies. So we see a shift here from the traditional sector into the technology sector, and also what I mentioned in the beginning, the increased interest rates are a factor which are in favor of the venture capital industry. This sounds a little bit counterintuitive, but the whole venture capital market employs much less debt than you have it in the traditional markets, and so the P&L of a traditional buyout fund or a traditional real estate fund or infrastructure fund is much more affected than the P&L of a venture capital fund, because there's much less debt in those companies and in those funds. Okay, so all those three factors together are very much in favor of the venture capital side.
So Michael, you've heard tailwinds for VC funds. Now you invest as a partner at Golden Gate, you invest in Southeast Asia. Are you, in terms of your fundraising, are you seeing those tailwinds?
Well, not at the moment. I think the markets since 2021 has significantly shifted. We saw in different regions, and especially across Asia, where a number of new funds that haven't invested in Asia before came to market, whether it was the larger PE funds, the larger hedge funds out of Europe and US. In times like current times, we don't see those large investors anymore. So when it comes to the later stage rounds, kind of post-Series B, it takes a longer time for these companies to fundraise. They're raising at a significantly lower valuation than they did 2 years ago. So I think in terms of the technology market and technology companies, we saw an amazing 2021, fairly high valuations. Those have clearly come down, very significantly.
So as valuations come down, the appetite for your funding, for people who are funding you, has come down as well.
Yeah, I think also the LPs are taking a longer time to invest in managers. I think if now spoke with a number of LPs over the past months, and for some of them they kind of want to see the bottom of the market, and they want to understand how deep these valuation cuts are. We're seeing secondaries happen at 60, 70, sometimes 80% discounts within the venture market. And for LPs that have seen these high valuations and high marks on paper in their portfolio, for some of them they're seeing those returns on paper diminishing. So yeah, fundraising does take a bit more time for some of the GPs.
Mohammed, you're focused on Mina.
Yes.
There's this perception that this region's been immune to some degree from some of those problems. All I hear about in the US is folks wanting to come out here to raise capital. What's happening out here?
Well, first of all, thanks, AIM, for hosting us. Really appreciate it. And thanks for the audience for sticking in there. It's the tail end of the program, so hopefully we'll make it well worth it. In terms of your question, look, nobody's immune. And frontier markets happen to have a lag effect. But in this particular scenario, I feel like we kind of got a bump. And because of the great macro climate, particularly in Saudi, we're a Saudi fund, it's a nation building, it's booming. It seems like we've weathered that storm. We had a bit of an effect, but things are on the up and up. In terms of the microclimate of NEMA, we were lucky, one of the lucky ones, because we raised most of our fund in 21, 22, and we were disciplined in deploying in 2021. So for all the entrepreneurs out there, we're writing checks. So it seems like it's a good scenario. I happen to also be an angel investor in Silicon Valley through Sun Hill Angels, and the picture there is gloom. It's completely different. Unless you have .ai in your startup, you're not going to raise.
But it's the new crypto, right?
Or crypto, of course. But so the macroclimate is much better for us here in Mina.
So let's just stay on this for a second. So what advice do you have for either founders or people raising a fund who think they're going to come to the MENA region and raise capital?
So I get that message
All the time.
Every day, I've
There's this
lost control
bizarre
of my
perception
LinkedIn.
that you get off the plane and there's somebody
Exactly. There's
with
a sign
bag
that
of
says,
cash just
"Come,
handing it out. Yeah.
Exactly. And we were at the FII, last week, so that was a center of gravity in terms of fundraising, etc. Look, I say come from a position of strength, right? Because I can always counter to an entrepreneur that comes and says, whether you're in Silicon Valley, whether you're in Europe, in London, etc., I'm raising from here and I say, we're an early stage fund. We roll our sleeves, we become part of the value add. How much value can I add if you have 0 investors in your circle of influence, in your geography, and I'm sitting across the pond? I don't mind being part of a syndicate where you're going to look at us as the Trojan horse to enter this market, but for us to be the only people on the cap table, I could say because it's you couldn't raise from we had a startup that was in the Bay Area. And I said, you couldn't raise a penny from Sand Hill Road. 95% of world VCs are on that street. Why shall we be deploying with you here? And the counter argument to say, fund me so I can move to the region. Why move to this region if it's not a good fit for your product or for your service? So I'd say think about why you're raising. The family offices, the VCs, the sovereigns are being bombarded. What's differentiating you? What's your skin in the game to this region? Because it's not going to resonate.
Yeah, there's this bizarre belief that if you set up an office here, you magically become very attractive to sovereigns.
Yes.
That's like me saying I'm going to move into Taylor Swift's neighborhood because she's going to date me. Those two things are not, correlation does not equal causation. So,
by the way,
agreed.
just to get on that, it's expensive to come out here.
Yep.
So you have to justify the P&L. It takes a long term to transact. It's relationship building. So allow yourself, you're not going to hit the ground running. You're going to have to show that you've got, as I said, skin in the game into this microcredit.
So Yalda, we've heard reference to secondaries. That's what you focus on. Michael mentioned steep discounts, 50, 60, 70%. So in one sense, I think as an LP, wow, this is a great, cheap assets. In the other sense, I think, yikes, this seems highly distressed. What if these should be 90% discounts? Walk us through what the market is right now for secondaries and why it's so attractive.
No, absolutely. I think we shouldn't be surprised at all with the rise of secondaries in the venture capital world. Think of every single other asset class. Think of real estate, commodities, cars, public equities. Typically, the secondaries market is orders of magnitude the size of the private market. And it's actually an anomaly that in the venture capital market, the secondary market is only a tenth of the primary market, and you have $1 billion of capital chasing primaries as opposed to chasing secondaries. But by virtue of these companies choosing to stay private much longer, you're seeing a convergence towards secondaries away from primaries, and effectively two sources driving the opportunity. First of all, you have early stage funds that have 2 or 3 companies that make up 70 to 80% of their NAV, and they need to materialize exits for DPI in order to raise their next funds. So again, they've held these positions for longer than a decade now, and saying that the IPO window, as we were discussing earlier, is probably closed for the foreseeable future. They have no other way to monetize their positions than to be active participants, active sellers in the secondary market. And then you have employees and founders that effectively have 90% of their wealth tied into one company. And for personal reasons, they may wish to upgrade their lifestyle or buy a house, and banks don't lend to them against those shares that they have in these companies, so they decide to de-risk. And that's, again, that's the space in which Bracket operates, whereby we provide liquidity solutions to early investors wishing to divest. And as a result, on our end, from a fund management perspective, we're optimizing really for IRR and for DPI by pursuing this strategy, because we're active market makers buying secondaries. We're also active market makers selling in the secondaries a position prior to IPO. If we think that it's a company that's not necessarily tier 1 and won't do well in the IPO, we won't shy away from making a liquidity solution within our funds. So these are some of the opportunities that exist. To your point about 50, 60, 70% discount, I think it comes down to, with the tiers of companies. You're not going to see a 60, 70% discount in a SpaceX. You're not going to see 60 to 70% discount in really tier 1 companies. On the contrary, these are actually trading at a premium. But yes, in tier 2 companies that were inflated by the Tigers and SoftBanks of this world, and now you see a multiple compression happening in public markets, and as a result, it's translating into private markets, then yes, you may see those discounts happening. And again, that's where the opportunity lies. Just one more point, and with regards to bracket, we manage capacity-constrained funds, right? I think for the much larger funds in secondaries, over $1 billion, it's much more difficult for them to actually be price makers. We're able to do it because we can write smaller check and again, really lay into the arbitrage opportunity that exists.
Okay, I just want to make sure everyone gets time. Jörg, actually, I'm sorry, let's stay on this because I want to talk about secondaries. Are you seeing pressure, is there pressure from your LPs to participate more in secondary transactions or find liquidity in other ways?
I would say not so much from the LPs. Most LPs in venture, specifically in Southeast Asia, is pretty much very patient capital. They don't see the need, at year 7, 8, or 9 to kind of pressure GPs to do secondaries. But yeah, to the point earlier made, when you are raising your next fund and you are looking for DPI, and when LPs are looking for track record, and they oftentimes when it's fund 2, 3, or 4. They want to see DPI coming from the previous funds. That's where GPs are naturally looking for more liquidity and are pressuring themselves to start doing these secondaries.
Why do you think some of the so there's secondary platforms, right? Forge and others. They've done okay. Not given the latent need, not as well as I would thought. Any ideas to why they haven't taken off?
I can speak a bit from I guess Southeast Asia perspective. It's sometimes very hard to assess an asset which is in an Indonesian tech company which services clients in Yogyakarta. Like, how do you explain this to a secondary buyer? For us as a GP, we know the founder. We spend a lot of time. We see the value. We know the value that has been built up over the years. But to explain this similar asset to a secondary buyer, oftentimes becomes very, very difficult. That's some of the things that we've seen. The point earlier made around pricing, even at these heavy discounts, if it's not a tier 1 company, any tier 2 or a tier 3 company is just facing very, very heavy discounts if they get picked up at all in secondaries.
Okay. Jörg, any thoughts on this? You've had a good run. VC's had a great run. A little bit of a stumble recently. What can make the asset class even more attractive going forward?
Yeah, I think what Michael just mentioned is a very important issue. I think there are two factors which could make the asset class much more important. One is information, and I mean what Michael just explained, that the secondary market does not work because there's not enough information around, especially on the second or third tier company. I think that's true for the whole venture capital asset class. The whole asset class is suffering from not having enough information circulated, being available to investors. We as fund investors, we are KfW Capital. We are, by the way, one of the largest LPs in European venture. Very often when there are other LPs interested in that asset class, they turn to us and they ask us very basic questions. Which are funds, which are GPs we should look at, or what are the sectors which are attractive, and so on, or what vintages. And this is something you cannot imagine having that on the liquid side, because there you have Bloomberg, you have all the terminals and information system. There's basically not much information available on the fund side or on the primary tech company side. So I think this needs to be improved. We get this question very often from the German government and also from other governments. What does it need to improve the functioning of the venture capital ecosystem? So more information, more transparency is clearly one thing. And the second thing is liquidity. We have not enough liquidity in this market. So secondaries are a very important tool to increase liquidity. Secondaries not only on a company level side, we also need secondaries on the fund level side. I mean, imagine you're investing in a venture capital fund. Those funds have a life cycle of 10 years, usually extension period 1 year, 2 years. So you're looking at 12, 13 years. That's more than the average marriage time in Germany. So people get divorced prior to that. So an investor who needs liquidity in this unforeseeable time, I think they have no alternative. So there are a lot of investor groups which stay out of the market because there is no functioning secondary market. So turning it around, I think there is a huge opportunity for secondary funds to tap into those illiquid markets. Right. I mean, in the US, we have the proof that it works. Yeah. But here in the region or also in Europe, there's really a lack.
Just be careful what you wish for, because there are a lot of LPs who like the fact that those returns are hidden for 10 years. There's a lot of CIOs who love that they can hide their losses in a 10-year vehicle if they had a mark-to-market with a hedge fund. So I hear what you're saying, but from a liquid public markets person, be careful what you wish for. Mohammed, we both love this region. You invest actively in this region.
Yes.
I've been coming here for 20 years. There's a lot of talent here. There's a lot of capital. The public markets are getting better. Why are there so few unicorns?
Well, look, I mean, we ask that question every day, right? I mean, the fund is modeled around making the 1-2 winners to make up for the fund. That's the asset class we subscribe to. There's a lot of unicorns in the making. This is a frontier market. This market is developing as we speak. There's a lot of programs by the government in Mina to accelerate this. So I know in Saudi Arabia, there is the unicorn program that has about 23 startups that are actively, accelerating this. But remember, this is a nascent market. It's developing as we speak. The macro or the TAM is there to develop them. We just need more time. To take my world, which is 3 founders, 2 founders, a founder, and an MVP, into the public equities market, that's 6-7 years. In good years. It stretches out. We need that time. We need those cycles of repeat founders. By the way, we're now hearing the term the Kareem Mafia, just like what we were hearing about the PayPal Mafia. We need repeat founders. And by the way, there's a great book called The Super Founder. We now know statistically what creates unicorns are repeat founders that have generated an exit of 3 million and more. So that needs some entrepreneurial cycles. Are we going to get there? That's what I'm betting on, right? I mean, that's what Nema Ventures is all about, making the 40, 50 bets that from it, that 5% will become unicorn status to return the fund. So are we bullish? I mean, I left Silicon Valley to come create Nema Ventures because we firmly believe that our untapped, just Al-Hajj and Umrah alone can create 5 unicorns. Just, tourism can create 5 unicorns.
Are the majority of your founders from the region, or are they expats coming here to set up companies?
So part of our investment thesis is to double down on founders from this region. Because of that point, I think you and I discussed offline, even the ones that don't make it, because statistically we know that a lot of our founders won't make it. This is the asset class we subscribe to. That, investment in developing that talent, we want to back them in the next cycle. What we've seen with expat communities, whether they make it or whether they fail, they tend to be more transient. So, we're in it for the long term. That doesn't mean that we don't bet on non-MENA-based founders. We have a lot in our portfolio. Well, actually, we also bet on MENA-based founders in Silicon Valley because we view ourselves as the Trojan horse to these markets, and they have an affinity, whether the product or the founders, to this part of the world.
Okay. All right, so we got about 6 minutes left. We'll do a lightning round, about 1.5 minutes each. Yalda, we'll start with you. What is the most exciting sector, investment, or new product design in your sector, in your business, that you're really excited about over the next 18 months?
I'd say cryptocurrency.
Cryptocurrency?
Yeah, I'd say at a minimum, cryptocurrency is the gold of our generation, right? This is the base case scenario. And at the best case scenario, imagine when the internet started, if there was a monetizing value associated with www. All the companies that would have ensued would have been worth infinity. So now that you think about the next generation of companies, I think crypto is the value associated to that next generation of companies.
Like infrastructure plays, layer two, like anything specific around or thesis?
I think it's imprudent
Yep.
to have zero allocation to Bitcoin and the major coins at the moment.
Okay.
And obviously blockchain in terms of infrastructure is something that I would definitely pay extra attention to.
Great. You're going to get mobbed after this because everyone in
Probably.
crypto is dying for positivity. Michael, what are you excited about?
Oh, I saw this amazing AI company. No, I'm kidding. For me, it's predictive healthcare. I think with the amount of devices that we're all wearing on us, whether it's hands, wrists, or our phone, the amount of data we're gathering about people's health, whether it's mental, whether it's physical, whether it's towards medication. We've invested in a number of healthcare startups. And
Hardware or software?
preferably software.
Yeah.
But what we're seeing is the amount of data that all of these telemedicine companies, healthcare companies are gathering, and the value that you can extract out of those companies, and actually think about predictive healthcare over the longer term with more chronic diseases, with pandemics. I think that's one of the things that I'm hyper bullish on.
Okay. Jörg?
I'm very enthusiastic about two things. One is diversity and the other is inclusion. I think this is very important for developing all the skills we need in order to tackle the challenges we are facing in that world, starting with climate, with the environmental situation. So I think the more diverse and the more inclusive we get in the financial services industry, the better we are prepared to tackle those challenges.
Now, we discussed backstage, there's a significant backlash in the US. I can't speak for Europe and the rest of the world, but significant backlash to what I'll call the initial attempts at ESG and DEI. Is that resonate in Europe? Are you aware of that? And if so, you have a response to it?
Yeah, I'm aware of that, but I'm really astonished about that because I see ESG as a risk factor. So when you do an ESG due diligence, you focus on the environmental risks, you focus on the social risk and on the governance risks. Whereas impact is doing good, is trying to improve the situation. ESG is really trying to avoid risks. And I wonder about that backlash because ignoring those risks cannot be a solution in order to do better investments, to have a better risk return profile.
Mohammed?
The region. I mean, what I'm most excited about is Mina. I mean, I happen to be lucky to be living in a city, Riyadh. It's going through 10 giga projects. I mean, you see around in the UAE the tremendous amount of energy, of building. So I think we haven't even scratched the surface. I genuinely believe we'll hit the winner for the fund in 24. And by the way, VCs or
You'll think you'll invest in a unicorn in 2024?
I think the one that would really be disruptive is in 2024 because.
Will it exit here? Will it list at ADGM?
Yes. And by the way, speaking of exits, we used to only rely on strategic acquisitions. And that was the base mark, right? I mean, you had the Kareem, Uber exit, you have the Souk exit. Now our public equities markets have become a much more profitable exit. We saw Fawri in Egypt, we saw Jahiz in Saudi Arabia. It's actually a discount to go and sell to a strategic. So I think, third of all, our conglomerates, the Aramcos, the Sabics, now are going into M&A as a strategy, right? So they're going through an acquisition. So the exit outcomes are becoming extremely favorable. We have not just one option. Now we have 4 options of exits that are developing.
It's important because, I mean, NASDAQ is NASDAQ because a little company called Microsoft decided to list on it. And so I don't think that there's maybe less of an understanding in terms of building capital market infrastructure here and building liquidity. It just takes 1 or 2 massive unicorns listing on an exchange to pull liquidity in, and liquidity begets liquidity. And so I really hope you're right, and I really hope the founders push to make that liquidity event local. All right, we are at the end. We're going to be on time, Rachel. Thank our wonderful panelists, and enjoy the rest of the conference, everyone.
Thank you.